Hey, good morning once again, options traders. Well, over the last couple of weeks, we've had a number of traders asking questions and posting comments about different strategies, and all saying things like, well, if the stock moves up to this level or down to this level, what should I do? How should I adjust this position? Or what are the risks if this happens? And what I've noticed is that most of the traders are focusing on just moving the stock price. And that's what we call a static analysis. We're just looking at one factor moving. But when you are trying to assess risk in your strategies, regardless of what the strategy is, you want to think more about dynamic analysis. So what's the difference here? Well, again, let's go back over to a pricing model, and we've got several factors. We've got the stock price, the exercise price, risk-free rate of interest, we have the time to expiration, and of course, volatility. So in the Black-Scholes model, this is typically what's called a five-factor model, and then later they were revised to include dividends, or a six-factor model. So if your stock pays dividends, that's not really the end of the story. The question is, does it pay dividends over the life of your strategy? And if it doesn't, then dividends are just as good as a stock that doesn't pay dividends. You can just completely ignore that because it's not going to be a factor. But again, what traders do is they typically pick one of these factors and they start plugging away at it. So again, that's called a static analysis, and that's absolutely fine. It's good to understand this. In fact, it's really invaluable to be able to say if the stock price rises or falls, what will happen to my call or put price? What happens as the time to expiration falls? What's going to happen to my call and put prices? Or what if volatility rises or falls? Yes, you need to be able to move through each of these individually and have a really good understanding of how that's going to affect your call and put prices. But when you're dealing with real-world strategies, it's really not a good method because it's going to potentially expose you to some risks that you never saw coming. So this is where we start moving towards dynamic analysis. And again, we've got the same factors here, and the three that you're going to want to focus on the most are the stock price, time to expiration, and volatility. Why? Well, once you're in a strategy, you can't change the exercise price. For the risk-free rate, the options aren't real sensitive to changes in interest rates anyway. Second, interest rates don't change all that much, and if they do, we get lots of fair warning from the Fed. We're starting to hint at increasing rates or decreasing rates. We kind of have an idea of when that's going to happen. And then another reason is that when interest rates are changed, they're usually in quarter point increments. So don't worry too much about the interest rates. And again, dividends, they're either there or they're not. But the three things that can move on you, obviously the stock price can move. That's your biggest risk, is delta. Time will definitely move, but that only moves in one direction. We can only decrease the number of days remaining. And then finally, volatility. Volatility can go up or down, and what's going to happen to the position as these three factors change in combination. And again, this is what I find that most traders don't do. So a dynamic analysis is going to look more like this. Let's pick our strategy and stock price, exercise price, all those factors, we put them in. We say, okay, now let's increase the stock's price by 5%. What's going to happen to the strategy now? Now increase volatility by, let's say, 5 percentage points. Remember, this means going from 20 to 25 or from 37 to 42, 5 percentage points. What's going to happen now? And now let's take 5 days off the clock. All right, let's jot down that answer. What's the value of the strategy? Now let's do it with the stock price rising 5 percentage points, but volatility falling by 5 percentage points and 5 days coming off the clock. And what if 10 days comes off the clock? So do you see what I'm getting at? You want to run through all of these different combinations, moving all three of these at the same time. And then once you've done that, increase your ranges. What if the stock price moves either up or down 10%? What if volatility moves up or down by 10 percentage points? What if 10 days comes off the clock or 20 days? Run through these combinations. Now don't get too carried away with this and say, well, what if volatility goes to 0 or if it goes up to 150? And even though it's possible it could really take a big spike like that, if you run these ranges too big, you're never going to be able to make a decision. Instead, look back at the past volatilities, what's been the high and the low, and say what is a reasonable range to expect. And then let's divide them up into 2 or 3 subcategories and see what happens. What has been the high and the low for the stock price? Or typically, how much does it move within 30 days or whatever the time is for our strategy? And give yourself a decent perspective. Because again, if you run through all possible combinations, it's overwhelming. You'll never be able to make a decision. And this is part of where the art side comes in. You just want to say, out of all of the possible combinations, which ones are most likely? In other words, maybe 95% of the time, what would we be expected to see? Now, even though you can't go and run an experiment and say for sure this is what's going to happen 95% of the time, it's at least a better starting point than saying let's just move the stock up or down. So now that you have the basic idea, let's jump over to the Thinkorswim platform and take a look at an actual example using the Analyze tab. All right, so now we're into the Thinkorswim platform. I have Microsoft, and down below I'm looking at the 280, 285, 290, 295 condor with the stock at 288. So it's pretty much dead center between these two strikes. And this is our risk graph. The one in blue is the expiration curve, and the one in purple is the current curve. So remember, the blue one only applies at expiration, whereas the purple one applies right now. Now, one of the really nice things about the Analyze tab is we can come down here to this little box, and I can change the date. So I can say that if I just put this position on, what if time goes by? Let's click 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Let's try to at least get it above water here. All right, so maybe on about 8:31. So that's about 26 days from now before we're even starting to see some type of profit. But again, you don't want to just stop here and say, okay, I need to hold this for about a month and everything should be good. Let's also say, well, what if the stock price happens to go up or down maybe 5 points? And I can change that over here. So I've got a current stock price of 288. Let's take it up to 293. And if I do that, now I'm pointing to this portion of the purple curve instead of right here. So we would still be above water. We would have a slight profit, but certainly not as big, and that's because we're getting closer to this upper wing. What if the stock price fell from 288 and fell 5 points, let's say to 283? Well, it's fairly symmetrical. We'll just be over towards the left side, and I can look and say, all right, this is, at least we're in profitable territory. Now let's go back maybe to 288 and say, what if volatility increases 5 percentage points? Well, I can change volatility right here. Let's make this +5. That's what's called the volatility adjustment. So it's just how many points are we adding to or subtracting from volatility. So I'm going to increase it by 5 percentage points, and you can see that's going to push me down almost back to break even. So we've got negative vega right here. And what if we make this -5? In other words, volatility falling 5 percentage points. Oh, that would be great. But what if volatility falls 5 percentage points and the stock rises? So let's take that from 288 back up to 293. So I type in 293, and again, we're now pointing to this portion of the purple instead of towards the center. So it's definitely going to cut those profits about in half, but we're still at least above water. I could also change the question and say, where would the stock need to be with volatility down 5% to just break even? Well, I can drag this gold line right to that red vertical hash mark right there and look straight down below, and that's at about a stock price of 296. So then I can turn the tables and say, well, how likely do I think it is for the stock price to get to 296 in this amount of time? But hopefully you see the idea. This is the thing that I think most traders are missing. They just look at what if the stock price goes up or down, or where are the break-even points, and they stop their analysis. Start getting into the habit of looking at the stock price, days to expiration, and volatility. What if they all move up by a certain amount? What if they all move down? What if one moves up, the other two move down? Look at different combinations and get a range of potential prices instead of just one. And if you do that, you'll have a much better understanding of your strategies and much better expectations. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.